Understanding the characteristics and risk-return profiles of different asset classes is fundamental to constructing diversified portfolios that optimize risk-adjusted returns. Each asset class, equities, fixed income, real estate, commodities, and cash equivalents, exhibits unique traits, such as volatility, income generation, and capital appreciation potential. This makes it essential to analyze their dynamics and correlations to build resilient and effective portfolios. Key concepts in asset class characteristics and risk-return profiles. Equities are known for their high volatility due to market sensitivity and economic conditions. They offer the potential for high capital appreciation, especially in growth stocks. Dividend-paying stocks provide additional income, making equities a growth driver in portfolios. They carry higher risk but also higher return potential. Fixed income, or bonds, typically have lower volatility compared to equities and are sensitive to interest rates. They offer steady, predictable income from interest payments, providing regular and stable cash flow. Bonds play a crucial role in providing stability and mitigating risk in a portfolio. Alright, so real estate is considered a moderate risk investment, mostly because of its cyclical market behavior, and, it's pretty sensitive to local conditions. The returns here come from income generated by rents, plus there's always the potential for long-term appreciation. One of the big advantages is the reliable cash flow you can get from property operations. And, real estate often acts as an inflation hedge and helps stabilize your overall portfolio. Commodities come with high volatility, often driven by geopolitical events, supply and demand shifts, and currency fluctuations. The return potential can be pretty significant, especially during inflationary periods. Typically though, commodities don't provide regular income. Instead, they depend on price movements. Their main role is to offer inflation protection and diversification within a portfolio. Cash equivalents, like money market funds and treasury bills, are considered to have minimal risk and are often seen as the safest assets out there. The returns are generally low, mainly because there's limited growth potential. Income from these assets is low but, pretty stable. Their primary role is to provide liquidity and preserve capital. When we look at risk-return profiles, high risk and high return are typically associated with equities and commodities. Moderate risk and moderate return are more common with real estate. Low risk and low return are found in fixed income and cash equivalents. For inflation protection, real estate and commodities stand out. And when it comes to liquidity, cash equivalents are highly liquid, while real estate and alternatives tend to be less so. The importance of asset class dynamics and correlations really can't be overstated. Correlation measures how asset prices move relative to each other. Assets with low or even negative correlations can help reduce portfolio volatility. Diversification, then, is about combining asset classes with different correlations to smooth out returns and mitigate risk. For example, real estate and fixed income often have low correlations with equities, which can enhance overall portfolio stability.